So then a bunch of people have said, okay, how do we deal with this? And they've come up with something which people here call non-aggregate growth theory, or heterogeneous agent models, or so on. I don't know, Rob calls it, what does he call it? Dynamic, stochastic, general equilibrium, enterprise, something. So there are different names, so it's kind of all the same. The idea is just that you somehow build in heterogeneity in the economy. So here's like the very simplest way of doing it, and we want to see like how far we can get. So each individual is a potential firm owner with a production function, which is just Z, which is some productivity intercept, and times the production function. So Z here is just, so each individual like owns a private firm, so Z is just some guy's entrepreneurial ability or innate ability at running a firm. K is his capital. So also individuals have some wealth, and we just write G of A and Z as the joint distribution at time t. To make things interesting, we now assume, and because we're interested in capital market imperfections, and in capital misallocation, we assume that there's some capital market imperfection. In particular, how much capital you can use depends on your wealth. So it's sort of K is the capital you want to use, and A is the capital you own, or the wealth, kind of same thing. And you just say that you can only use up to a certain multiple of your wealth. So the idea is that so this is a very reduced form. There are like much fancier models of modeling these credit market imperfections. But the idea is just that if you go to a bank and you say, I've got this really good project, so I have a very high Z, I want to take out $1,000. The bank's going to say, well, wait a minute, how do I know you're going to repay me? You have to put up some collateral, and the collateral is your wealth, and you have to put up, I don't know, say you have to put up 50% of the loan and collateral that you take out. So then, I guess the lambda would be what, like 1.5, 2, no, 1. Yes, no, you're right, 2 exactly. Then the other assumption is that there's a credit market, which is competitive except for this credit market imperfection, and the interest rate R is determined in general equilibrium. Individuals are forward-looking as well. So, I mean, I guess I'll have to speed up a little bit. So, the alternative to acquiring capital on the market. So there is some credit market imperfection, so you're going to get capital misallocation, right? So the alternative to acquiring capital on the market, though, is to accumulate it, right? So you can just always, you're very high ability, the bank won't give you the money, so you're just going to try to save it up yourself. And actually, if you look at a model like this is going to be a very strong force to eliminating this misallocation. The reason is that the constrained firms, if you're constrained, you're going to have a very, very high rate of return. It's kind of what it means to be constrained. It said you have a very high of return, but you can't take advantage of it. It's like a definitional. So this is going to create a very strong pressure for accumulation. So I won't go through what this is, but misallocation basically disappears in the long run, and you actually get back to first best allocation in this like simplest possible model. And not even more so, this is very fast. So if you look at this model and you look at two guys, one is poor and one is rich, or one is very able and one is very stupid, doesn't matter. So that initially one guy has a 3 times higher marginal product, so that's huge, right? One guy has, I don't know, a 10% marginal product return on capital, and the other guy has a 30% return on capital. So the guy with the 10% return on capital should definitely always give the money to the 30% return on capital guy, but he can't because of the capital market misallocation. But now, what we can show actually is that very quickly this like gap in marginal product is going to disappear. So the reason is that people again like save themselves out of the credit constraint, basically. So
if you, I have one question. So like most of these misallocation papers are comparing like the US to like India or something. But so, do you think that in the US they have similar kind of borrowing constraints on firms?
No, so no, that's exactly why we think they differ. So we would think that the US and India have different lambdas basically, on what I had up there earlier. So K smaller equal to lambda times A, and we think that, I don't know. So people have estimated this, and for the US, people say like lambda is somewhere between 5 and 10, pretty high, and in India it's somewhere between 1 and 2%. So you can take out much less money for a given wealth level. So therefore, the allocation of capital will be much more tied to the wealth distribution, right? So and that's exactly the kind of the what people say. What the problem in India is that capital markets, or in Thailand or whatever, that capital markets are very high. But as I say here, then this shouldn't be a problem regardless. So if you look at different lambdas, it's gonna it's gonna increase or decrease the speed of like how fast these distortions are eliminated, but they should go away pretty quickly, and they should go away in like 4 or 5 years. So let's see what's next. So something's wrong with this model, because obviously this misallocation does seem to be there in the data. So what can we do to like fix this model in the most easy way? So some people have argued that with fixed costs you get big output effects and big TFP differences. So fixed costs is, I mean, very realistic phenomenon, right? So you just, if you want to start a business, you have to pay some sort of fixed cost, or so you have to invest in your organizations or machines, or if you or your marketing, or also suppose you have some sort of technology, you're operating at a small scale, but you want to like bump up your business, you want to expand, so you also have to pay a fixed cost in order to build a new factory or something. So that's also an example of fixed cost. What these fixed costs do, I mean, in terms of technical language, they introduce what's called a non-convexity in the production function, and they create these like weird effects where you have thresholds over which, like, either you do nothing or you do a lot, and those kind of things. So in particular, if you have fixed costs of starting up a firm, there's going to be a bunch of people who think they're not going to be productive enough to recoup the fixed cost, so they won't produce at all. Here again, and there's going to be a bunch of other people who are going to produce. So now you're actually going to have two forms of misallocation, which I want to stress, which is one's what we call misallocation on the intensive margin, which is just exactly what we had before, that marginal products aren't equalized. And the other one is, sorry, this should have been extensive margin, obviously. So misallocation on the extensive margin, which means that the wrong people are in business, basically. So there's going to be, as I said, there's going to be some people who are in business and some people who aren't. And because of borrowing constraint, it might be that you have a really good idea, and you want to really start a business, but you have to pay this fixed cost. And given that there are borrowing constraints, so you can't borrow enough capital to actually cover that fixed cost. So that's called misallocation on the extensive margin. So the definition is that if you can redistribute capital from one guy to another and you increase your joint production. It's kind of different conceptually from the other one, but